The stock market should have already crashed. Every indicator is flashing red. Consumers are drowning in debt. The economy is cracking. Yet the market is still rising. Why is the financial system holding together when all the historical warning signs point to imminent catastrophe? I am the financial coin historian. I have worked in finance, and I look at the markets with the skepticism of a historian who knows that history does not repeat, but it certainly rhymes. Today, we are witnessing an unprecedented market paradox. We are at valuation levels higher than the peak of the dot-com bubble, yet the crash everyone expects is delayed. The uncomfortable truth is that the banks and Wall Street do not really want you to understand why this delay is happening. Because once you understand the three hidden forces quietly propping up this market, you will realize that the delay is the most dangerous part of the entire cycle. This is not a prediction of doom. This is an exercise in pattern recognition. We will break down the sheer valuation insanity, expose the three hidden forces of resilience, and uncover the mechanism of risk externalization that Wall Street uses to shield itself. The foundation of the paradox is this. Every fundamental indicator screams that the market should be in free fall. We start with the metric favored by legendary investor Warren Buffett. It compares the total market capitalization of all public companies to the U.S. gross domestic product. This ratio is shouting that the market is severely detached from reality, the disconnect. The total market cap of all U.S. stocks is approximately $66 trillion. The U.S. GDP is about $30 trillion. The ratio. When you divide $66 trillion by $30 trillion, you get 220%. The history. Anything over 100% is considered fundamentally overvalued. Before the dot-com crash in 1999, the ratio hit a peak of 115%. The market then collapsed by over 60%. Today, we are at 220%. This represents an unprecedented scale of concentration and risk. The delusion is not just how high PE ratios are, it is the dangerous concentration of growth in a few names. The tech extreme. Historically, S&P 500 companies have PE ratios around 15 to 16. Today, it is running 25 to 28, which is already dangerously high. But the concentration is the real problem. NVIDIA's PE ratio is 53 to 55. Tesla SPE ratio is 286. Investors are paying $30, $40, or $50 for each dollar in earnings. This is the classic madness of men that Isaac Newton described after losing his fortune in the South Sea bubble, the 1999 echo. Before the dot-com crash in 1999, S&P 500 PE ratios were running 29 to 32, roughly the same as they are today. All these structural and historical signs indicate a market crash is overdue. The market stability is upheld by potent self-reinforcing factors that Wall Street relies upon but prefers you do not scrutinize. The first reason the market keeps climbing is government spending and currency debasement. This is the mechanism of the invisible wealth transfer. The cause. The government issues massive debt, which the Federal Reserve effectively accommodates through digital money creation or quantitative easing. The mechanism. This money flow does not fall evenly across society. It flows first to the financial system, governments, banks, and asset owners. This is the Cantillon effect, a 300-year-old law that decides who wins and who loses. The wealth transfer. This policy benefits the top 10% of households who own nearly 90% of all stocks. As the dollar is devalued, asset prices numerically increase, making the rich richer. Inflation, which is a feature, not a flaw, of this system, rewards those who buy assets with debt and punishes those who hold cash. The market is being held up by a narrow set of market drivers and mechanical processes that amplify momentum. The AI engine. The market MES, sustained resilience, represents an artifact of robust corporate profitability overwhelmingly focused on artificial intelligence, AI, investment. The absolute valuation scale of these AI giants is unprecedented. This introduces extreme duration risk because these valuations inherently incorporate highly extended earnings growth assumptions. Passive dominance. This risk is mechanically amplified by the overwhelming dominance of passive investment strategies, which now exceed 50% ownership of the S&P 500. This dominance surpasses established thresholds for healthy price discovery. The crash mechanism. When a market downturn inevitably occurs, passive funds are mandated to sell proportionally to the index components. This means the downward pressure is amplified in the largest, most concentrated stocks. This structure, which the banks benefit from in a rising market, ensures that when the market falls, it falls faster and harder than ever before. The core reason that what banks do not want you to know. Why a crash has been avoided is the successful regulatory arbitrage. Post-2008 reforms. Laws like the Dodd-Frank Act were implemented to make regulated banks look stable and compliant. The externalization of risk. Major financial institutions successfully shifted their riskiest exposures specifically high leverage lending off their regulated balance sheets and into the opaque, less regulated non-bank financial intermediation, NBFI sector, or shadow banking. This $4 trillion shadow banking system is not subject to the same capital rules as commercial banks. The hidden vulnerability, the critical systemic risks, such as highly elevated default expectations in the leveraged loan market, 7.3%, 8.2% forecast for 2025, reside entirely in this shadow sector. This allows the conventional banking system, GSIBs, to appear resilient. The structural instability is masked by the apparent stability of the regulated banks, preserving the potential for systemic contagion in a manner that financial institutions are incentivized to downplay. This is a loophole written large enough to drive Wall Street through. The stock market has not crashed yet because people mistake delay for safety. History teaches us that every generation believes it is smarter than the last, right up until they lose everything in the same way. The sequence of delusion. Bubbles are not accidents. They are the system's business model, engineered by those with money and power. The South Sea bubble, the 1929 crash, the Dotcom crash, and the 2008 housing crisis were all built on the delusion that this time is different. Oh, it never is. The three phases of collapse delay. Crashes are always preceded by the same psychological sequence. Phase 1, irrational staying power. Markets stay high for longer than anyone thinks is rational. We are in that phase now, where the market feels entirely disconnected from reality. Phase 2, crash fatigue. Investors become numb to bad news. People hear inflation, corporate layoffs, and earnings warnings and eventually stop caring. This is classic pre-crash behavior. Bad news stops moving markets right before the moment it matters. Phase 3, the confidence break. A single confidence-breaking event hits. A bankruptcy, a credit event, or a major company missing earnings triggers a chain reaction. Confidence collapses, selling accelerates, and the crash everyone expected months ago finally shows up. The crash is cued, not canceled. The longer it is delayed, the bigger it becomes. The market will snap back to reality when those temporary forces, the money flood, and the structural concentration, weaken. The structural truth is this: the system's stability rests not on gold or productivity, but on confidence. And confidence is the easiest thing to lose. The transfer is inevitable. When the system breaks, the rescue is rarely about the average citizen. Laws are designed to protect institutions, too big to fail, not the saver crushed under the crisis. The outcome is always a transfer of wealth upward. The cash trap. Holding cash is a guaranteed loss due to perpetual inflation, which functions as a lifelong invisible tax that the government uses to erode its debt. You are being punished for prudence and pushed toward speculation. The strategy of the prepared. Financial sovereignty begins with intellectual sovereignty. The rich protect themselves by positioning outside the system's reach. This means owning things that matter. Assets that produce income, such as land, businesses, or intellectual property. It means holding real value that cannot be inflated away or frozen by decree, like gold or scarce commodities. The final lesson. The market has not crashed yet because of the hidden forces of leverage, concentration, and regulatory arbitrage are holding the illusion together. But physics does not change. You cannot expand claims forever without real backing. When the collapse comes, it will be sudden, and only those who saw the structural weakness beforehand will be ready to seize the massive opportunities created by the forced liquidation. History has the answers. It is up to you to look.